Good morning. My name is David Watkins and I'm the leader of the Deloitte Tax Insights and Policy team here at Deloitte Australia. And for the last 10 years, I've been the Deloitte lead on the tax measures in the federal budget. I would like to welcome you all and thank you for joining this presentation on last night's budget. I also acknowledge the traditional owners of the various lands on which we all meet today and pay my respect to their elders past and present. This is our agenda for today, and I'll be joined by two of my partner colleagues in this presentation, Liz Westover, who focuses on superannuation, together with Enzo Coia, who is a corporate and international tax partner. The agenda is fairly self-explanatory, but perhaps two introductory points. We'll spend a little bit of time setting the scene before we get into the substance of the budget. And across those various topics, we'll spend most of this presentation today looking at business taxes and also superannuation. So by way of setting the scene, this presentation today will focus on the tax measures in the budget. We won't take an economic perspective. We won't focus on the cost of living measures, albeit that they were significant, certainly from a political and a spending perspective. We'll focus today on the tax measures, and as I say, principally relating to business tax and also superannuation. And indeed, we'll focus just on the key tax measures. So with that focus around tax, I guess I describe this budget as a 9-to-5 budget as opposed to a working overtime budget, or as opposed to doing a lot of heavy lifting. There's lots of things that are not in this budget. There's not a lot of tax law change. There's a bit, but not a lot. In terms of the long list of announced but unenacted measures, the so-called ABUMs, there's really no clarity or update on those various measures, with one notable exception. This budget does not start to even scratch the surface around tax reform, doesn't really even float that as a priority for the country, but it is, and it will have to become so shortly. The budget doesn't take on any bold changes to encourage investment, to attract capital into the renewable sector to support the transition of the Australian economy. So lots of those bigger decisions are left for another year, left for another budget, left for another time in the electoral cycle. Positively, I would say that there's no big shocks in the budget for business. There's no big shocks, and that of itself is a good thing. So before we get to the budget, let's, as I say, set the scene. We're here in the middle of May, and ahead of us, running up to 30 June of this year, we have a legislative logjam. There's a lot of tax measures, amongst other measures, that are before the Parliament. So let's just refresh ourselves on that. There's two bills, the red boxes, there's two bills currently before the Senate. One of those deals with the digital games tax offset and also deals with the boost deductions. You'll recall they were the 20% additional deduction that was announced by the former government in the March budget of last year. And indeed, one of those boost measures expires shortly. We're still yet to have the law finally passed. The other bill before the Senate deals with two franking-related matters, off-market buybacks and the capital raisings and franking distributions matters. That bill is awaiting a Senate committee report, which is not due until the end of this month, 26th of May. So both those bills are still working their way through Parliament. Perhaps more significantly are the various exposure drafts that are out there. Three of them relate to a collection of multinational tax measures, deductibility of interest, deductibility of royalty and other intangible related payments, and public country-by-country reporting. They're all significant matters, they're all complex matters, they're somewhat controversial. They are all sitting in exposure draft at the moment, notwithstanding that each of those three measures start with slightly different start dates, but essentially start from 1 July 2023. There's also an exposure draft out there relating to superannuation measures with a later start date in 2025. So there's a lot of work ahead of Treasury to finalise bills, to get bills into Parliament, to get them and for Parliament to debate and pass those bills. And I think the reality is that it is unlikely that all of those three multinational exposure drafts will indeed be law before 30 June. It may be that the interest measure runs ahead of the schedule and may get royal assent before 30 June, but I think there is a strong chance that one or more of those exposure drafts will not in fact be final law, having received royal assent by 1 July 2023. So that's not an ideal situation for anyone, but that is the position that we're in. And as I say, there is a legislative logjam ahead of the Parliament over the next month or so, with relatively limited sitting periods. There's a week or so sitting period at the end of May, early June, just to the lower house, and then both houses sit in mid to late June. Importantly, I'd also say that in respect of those various exposure drafts, there was nothing announced in the budget last night which would materially affect those measures. So the government's view on those measures, which is we keep our election promises, remains the overriding mantra. Announced but unenacted measures. There's a long list of these measures, some of which are shown there. Definition of company resident, Division 7A. Different of these announced but unenacted measures will have different impacts for different segments of the taxpaying community. No update on any of those measures. The only ABUM which was addressed last night was in respect of the patent box, and that is as simple as the patent box will not proceed. That was a measure that was developed by the coalition government. That was indeed, it got into the Parliament, introduced as a bill before the election, but that measure will not proceed. So if I describe this as not a heavy-duty tax budget, not a lot of tax law change, etc., how is it that the budget is in surplus? How is it that there seems to be significant cash in government coffers? And I guess there's 2 points I'd make on that. Firstly is significantly greater than expected company tax revenue and personal tax revenue. This chart here just tracks company tax revenue. And to try and put it in perspective, if you look at the left side of that slide, these are various budget estimates for the 22-23 financial year, the year just finished. And you'll see there's 3 bars in respect of 22-23. In the left-hand one, the shortest of those, which is about $104 billion, that is saying that in April of 2019, the 2019 budget, before COVID had emerged, government treasury forecasts were expecting that in the 22-23 year, company tax revenue would, for the first time, just come over $100 billion, $104 billion. If we go back to October of last year, just 6 or 8 months ago, that revenue forecast expectation for the 22-23 year had increased significantly to $127 billion. And indeed, what was reported last night is that company tax revenue for the 22-23 year is $138 billion. So you can see that consistent story as you look out across the right-hand side of that chart, that company tax revenues are surging, and even compared to what was expected to be collected, even compared to the forecast as of October last year, company tax revenue is exceeding those forecasts. That's for a range of factors, commodity prices, inflation, various factors, and a similar story is also playing out in respect of personal tax collections, largely attributed to very low rates of unemployment. So company tax and personal tax revenues are exceeding expectations. The other source of revenue, which is interesting, is if you look at some of the key revenue numbers that were in last night's budget, I've just pulled out a few of these. revenue expected to be collected from superannuation measures, revenue expected to be collected from changes to PRRT, to the introduction of Pillar 2. But the biggest number, the standout number, is the last number, $7.6 billion of revenue. That is far and away the largest revenue measure in the budget announcement last night. $7.6 billion attributed to additional funding to the ATO for a GST compliance program. We'll talk a little bit more about this later, and it's expected to collect not only GST revenues, but other revenues. But indeed, that is a little bit of a theme of the last couple of years' budgets. Additional funding to the ATO tied to particular programs, tied to particular revenue targets. And as I say, that is the largest single revenue item in the measures that were announced last night. So moving on and getting a little bit more granular, the key announcements that we'll focus on for the presentation today are summarised here. The government has finally and formally announced an implementation timeline for Australia to adopt the Pillar 2 measures. Part 4A will be widened and strengthened. There will be changes introduced in relation to PRRT and some other resource-related matters. There will be some modest incentives provided for electrification, for certain construction, and for instant asset write-offs, targeting small businesses. I've mentioned the significant additional revenue expected from the GST compliance program. Number of superannuation changes, most significant of which for business will be an acceleration of payment of superannuation contributions, so-called payday superannuation. And again, a theme in the budget last night is significant and various additional funding for the ATO. It's, often at sort of budget time, people talk about winners and losers. On one perspective, the winner in this budget is the ATO. The ATO's hand is very evident in the changes to Part 4A and some of the resource-related tax changes. And the ATO is also a significant beneficiary of large additional funding across a range of programs. I won't kind of read through all of these programs, but you can see there's a wide range of areas that the ATO will be funded to focus on, and each of those areas are tagged with revenue targets. All right, so that's by way of introduction. Let's start to get a little bit more detailed. Firstly, in relation to individuals, and the short story there is it's a short story. There was no particular measures announced relating to individual tax. The existing marginal rate tax scales will remain as is, and the proposed so-called Stage 3 tax cuts due to commence on 1 July 2024, the government has left them as is, and at this stage is saying that they will proceed as announced. So if we then get to the business tax changes, let me start initially on Pillar 2, and then I'll ask Enzo to pick up additional items. So firstly, Pillar 2, everyone would be aware of the OECD project over the last few years dealing with Pillar 1 and Pillar 2. Pillar 1 is not running to the timeline that was expected, and let's leave that aside for the moment. Pillar 2, which is essentially a global minimum tax, a minimum tax of 15% for large multinational businesses, that is actively being introduced in the UK, in Europe, starting from 2024, and indeed in a number of other countries. What was announced last night is that Australia will also be at that forefront, the first wave of the introduction of Pillar 2. And there's three elements to Pillar 2. One is a so-called domestic minimum tax. So where there is, or if there is, low taxed income in Australia, an effective tax rate of less than 15%, that low taxed income is susceptible to being taxed by other countries under one or other measures of the Pillar 2 regime. Australia will introduce a domestic minimum tax, as indeed many other countries are, to ensure that that under-taxed income is at first instance taxed in Australia. That measure to commence from 1 January 24. An income inclusion rule. This is relevant for example, for an Australian parent company with foreign subsidiaries, where there is low taxed income in those foreign subsidiaries. First and foremost, that low tax income may indeed already be attributed to Australia under the CFC rules, but if not, the income inclusion rule will pick up that income and attribute it to the Australian parent to be taxed at the global minimum rate of 15%. That measure also starting 1 January 2024. And the third element of Pillar 2, the UTPR, under tax profits rule, again, consistent with global practice, that will come in with a 1-year deferral. The most interesting part of this for me was what are the revenue estimates associated with Pillar 2, and they're relatively modest. And that's not unexpected. Australia has strong CFC rules, strong high levels of voluntary tax compliance, effective tax administrator. It was not expected that significant revenue would flow to Australia under these rules, and that's borne out by the forecasts. Two final comments on Pillar 2. Firstly, as I mentioned earlier, one of the exposure draft measures that's in progress is a proposal to deny deductions in Australia in relation to payments offshore connected with intangibles. That measure is not really compatible with Pillar 2, and it's not clear how that measure will interact with Pillar 2. The government made a couple of slightly cryptic comments last night to say, on the one hand, we'll look at how that measure will interact with Pillar 2, but on the other hand, that measure will nonetheless commence from 1 July 2023. I think reading between the lines, it might be that the unilateral measure that Australia is adopting regarding denial of deductions in relation to intangibles, it may be that that's a temporary measure which will sunset once Pillar 2 is effective not only in Australia but other key jurisdictions from 2024. And the last point I'd make is that, consistent with the legislative logjam comment earlier, there is still a lot of work for Treasury and the taxpayer community to do to get ready for Pillar 2. Two aspects to that. One is legislation needs to be drafted as an exposure draft, consulted on and finalised. That will be a real challenge to get that done in an effective way before the end of the year. So a lot of work on the legislative design and drafting front. And also from a company perspective, a lot of work to be done to put appropriate systems in place to be able to appropriately test and calculate the effective tax rate in various countries around the world. A number of taxpayers are well advanced on that process. Other taxpayers are less advanced, and the message from last night is Pillar 2 is coming. All right, let me hand over to you, Enzo, to pick up further business tax measures.
David, and welcome again to everyone. So David's just taken us through one global tax change that will affect those in all industries that meet the thresholds. The other, I'll call it global tax change that was announced in the budget last night, were the expansionary measures associated with Part 4A. And so whilst they were new and not previously announced, they're not wholly surprising. Part 4A was felt to have a couple of gaps in them, and these are the gaps that are sought to be filled by the proposed amendments. Those amendments will commence from income years starting on or after 1 July 2024, regardless of when your transaction or scheme was entered into. And those two principal amendments relate to, one, situations where the rate of withholding tax levied by Australia is less than it otherwise would, and two, where there's an Australian income tax benefit, but the dominant purpose is to reduce foreign income tax. So, as David said at the outset, there's a strengthening and a widening of the anti-avoidance rules. These measures don't have an estimated costing in the sense of how much revenue is expected to be raised. Perhaps there's more of an expectation of behavioural change to ensure that groups align with the intent of the proposed measures. If we go to the next slide, we can have a look at two examples to which the proposed amendments could apply. And so in this example, which is taken from a recent taxpayer alert, a group restructures itself to put an intermediary entity into the structure, and that intermediary entity is located in a treaty country which has a lower rate of withholding. You can see on the left-hand side, there's a 10% royalty withholding rate, and after the restructure, a 5% royalty withholding rate. And so that type of transaction might fall foul of the expanded Part 4A. If we look at the next example on the next slide, this is a situation where the group is resident in a non-treaty country and is proposing to undertake an acquisition in Australia. And to do so, it incorporates an entity in the middle in a treaty country and also an Australian holding structure. That Australian holding structure requires the group in the blue box, and you can see from that example that the interposition of the treaty company can result in a lower rate of withholding tax than would otherwise be the case. So expansions to the anti-avoidance rules to cover not only situations where the withholding rate is brought down to zero, which the rules already cover, but further cases where the withholding rate is reduced. So if we move on to the next slide, we start to see some of the business tax measures that are more focused either on a particular industry or a particular activity set. And the most focus in this year's budget from a business tax perspective is on the energy and resources sector. The information on this slide was previously announced, on the 7th of May. And that announcement really followed a considerable period of years where the petroleum resource rent tax was thought to be not collecting enough tax, thought to not be returning the right amount to the community in respect to the resources that are being used. And so following that announcement, from 1 July 2023, there will be a cap on the amount of deductions that can be used to offset PRRT income, such that essentially there's a 10% differential. And given that the PRRT rate is 40%, that results in a minimum effective tax rate of 4% in respect of LNG projects. So that's the key amendment that was announced on 7th of May and reconfirmed in the budget last night. There'll be further amendments that look to the gas transfer price and the methodologies that need to apply to price transactions, and they'll begin from 1 July 2024. And as we mentioned earlier, those measures combined are expected to raise $2.4 billion over the next 5 years. Given the technical nature of those amendments, we can expect a fairly detailed consultation process. If we move on to the next slide, and we're still staying in the energy resources sector and still staying with the petroleum resource rent tax focus, there'll be an amendment to restrict the breadth of which activities qualify for exploration deductions. So the PRRT rules will be clarified to ensure that feasibility studies do not qualify for that special category of expenditure, and that outcome will be consistent with the Commissioner's previous position articulated in the 2014 ruling. And you'll want to compare and contrast that to the more expansive definition of exploration and prospecting in the Income Tax Assessment Act, which specifically includes in 4730 subsection 4 feasibility studies to evaluate economic feasibility of the resource. So a difference in policy approach between PRRT and income tax. If we move on to the next slide, and again still staying with energy and resources, two separate amendments that emanate from the Shell Energy decision in 2022. The first amendment is to clarify, using the words in the budget paper, to clarify that mining, quarrying and prospecting rights can only be depreciated once they are effectively put to active use, not merely held. And so you'll recall in the Shell decision, the full federal court held that use of an intangible asset like a mining right can occur in a passive sense, holding that right and stopping others from accessing a site was sufficient to constitute use. And so this amendment will reverse that position. The second amendment relates to a situation where certain permits held before 1 July 2001 are not tax depreciable, whereas those acquired after 1 July 2001 are usually tax depreciable. And so there are instances where these pre-1 July 2001 permits can be renewed, but they relate to substantially the same area. And so the law will be clarified and amended to ensure that it operates in a way that denies tax depreciation deductions for those types of renewals, for situations where the current Section 4077 of the Transitional Provisions Act is thought to be lacking. If we move on to the next slide, and moving away from the energy and resources sector and focusing more on incentives, there are two main areas of incentives. The first area of incentives relates to an activity set, which I'll call building construction. And the second area of incentives relates to a group, small and medium businesses. So looking at the construction building incentives, the first incentive was a build to rent initiative, and that was announced on the 28th of April. So for eligible projects, and by eligible, some of the requirements will be size requirements, that the project has 50 or more dwellings, and that they will be made available for rent to the general public. The outcome will be that capital works deductions will be increased from the current 2.5% per annum to 4% per annum. And secondly, where the appropriate structure is in place, a final withholding tax rate of 15% rather than the current 30% will apply from 1 July 2024. There are other attendant requirements, such as that the project needs to be owned for at least 10 years under single ownership or continuous ownership, and also the terms of the leasing arrangements with the public need to be longer term. There's still some detail, particularly around the MIT associated aspects, to ensure that the rules will apply appropriately and that the activity set will qualify for that reduced 15% withholding. We also see that these measures broadly align with not only other federal measures, but state-based measures to incentivise this sort of activity. For example, as the last bullet point notes, many of the states are offering land tax reductions of 50% for these types of projects. So moving to the next slide, and the second of the building and construction related incentives, there's a more niche concession that will be available for clean buildings that meet the management investment trust regime. So currently, to qualify, the projects need to be office, hotel or shopping centre, and these extensions will apply to data centres and warehouses. The measures will apply from 1 July 2025, and there will be also an attendant need to increase the energy efficiency of those sites and existing sites to a 6-star rating as opposed to the current 5 or 5.5 star rating. So that's the activity set. Now, if we look at the next slide and start to focus on the taxpayer grouping set, and as I said, the two main incentives relate to small and medium business. The first one applies where groups have aggregated turnover of less than 50 million, and they'll be able to deduct an additional 20% of the cost of eligible depreciating assets. And those types of assets will be things focused on making things more energy efficient. So things like heat pumps, heating and cooling systems, and electric fridges and so forth will qualify, whereas other types of assets like electric cars and renewable energy generation assets will not qualify. The measure is expected to be useful in the sense that there's a costing estimate of $300 million over 5 years that the benefit's supposed to provide. So that'll be welcome for those small and medium businesses. If we move to the next slide, and the last of the two small business measures, different turnover threshold here. So the previous one was 50 million aggregated turnover. So this is a smaller 10 million aggregated turnover. And this is an extension of essentially the immediate or instant asset write-off. There'll be a $20,000 asset by asset threshold, but of course, small businesses can acquire more than one asset and remain eligible for the write-off. Where the assets cost more than $20,000, they can continue to be placed in that small value pool. That's a simplified depreciation pool and can be depreciated at 15% in the first year and 30% thereafter. So again, a welcome extension for small business for qualifying assets. If we move to the next slide, and back to an industry group, I'll call this one a realignment. And so not previously announced, but really care and maintenance of the tax system to allow insurance groups to continue to align their tax calculations to the accounting standards. And so this measure is really in response to the introduction of AASB 17, and the amendments to Division 321 will allow those groups to continue to perform those calculations in line with accounting standards. There's some detail that needs to be worked out as to whether the measures will apply to life insurance companies, and Division 320 will also be amended, but it's a useful guide to indicate that the tax system is keeping pace with accounting changes. So they're the key business tax changes. And as we touched on earlier, that's what we did see, but what didn't we see? Well, we certainly didn't see wholesale tax reform. We didn't see a move away from corporate and personal tax to other types of taxes like consumption taxes or GST. We certainly didn't see an unlocking of our rollover system, which would have allowed groups to restructure and transact more effectively. We didn't see some tidying up of long outstanding technical issues such as those relating to earnouts. And we didn't see confirmation of whether the rules around what's taxable and what's not for non-residents disposing of Australian assets signal as being updated to provide greater certainty. So perhaps all of those things are still working their way through the system, or perhaps they won't eventuate at all. David, back to you if you had any other observations from a business tax perspective.
Thanks for that, Enzo. And look, I think that covers the field. There's a range of measures there, some industry specific, some taxpayer group specific. Various of those measures will be of various degrees of importance for different taxpayers. If we move away from business tax then and shift on to superannuation, let me ask Liz to pick that up.
Thanks, David, and good morning, everyone. No big surprises for us in the super industry coming out of last night's budget, but we did have 3 measures that will still have significant impact for us in the industry and for Australians and their retirement savings. The first one was the better targeted superannuation concession. So as most of you will appreciate, superannuation is a highly tax concessional environment, and it is designed that way to encourage people and to support people to save for their retirement, for a comfortable retirement, and of course, less reliance on the age pension in their retirement. But the view is that individuals who have more than $3 million in their superannuation accounts probably don't need the same level of support from the government to achieve that objective. So we saw what was effectively a re-announcement, and it was originally announced in February this year, that the government will be reducing the tax concessions for individuals with a total superannuation balance of more than $3 million. And they'll be doing that by increasing that headline tax rate from 15% to 30% for the earnings attributable to the balances above that $3 million threshold. So the key points here to consider is, one, it will have no impact on individuals with a superannuation balance of less than $3 million. And for those who are fortunate enough to have a balance of more than $3 million, it's only going to impact earnings that are attributable to the balances above the $3 million. So it is business as usual, where your balances or the first $3 million, it is going to be taxed as normal and won't be impacted by this measure. Now, it's going to commence on the 1st of July 2025, and that is when super funds are going to report your total superannuation balance to the tax office, and they're going to do the same again 12 months later. And it is the difference between the two that is going to be impacted by these measures. So we'll start to see the first determinations issued in the 26-27 financial year, but due to the differences in the reporting timeframes from different super funds, we really are looking at the first full year of receipts in the 27-28 financial year, when the government expects to increase revenue by some $2.3 billion. So a fairly significant measure as part of last night's budgets. One of the key things I would like to highlight with this measure is that it will result in tax being imposed on unearned income. So that is, it is the growth in the balance that's being taxed, which can include actual income earned and also capital growth of assets held. So an important measure to note, it is not just an additional tax rate on your earnings, it will impact growth of assets in the meantime. The second measure that was part of last night's budget was payday superannuation, as David mentioned earlier. And what this will mean is that from the 1st of July 2026, employers will be required to report superannuation or pay superannuation guarantee entitlements on the same day that they are paying salary and wages. So currently the system is that it's a quarterly obligation. A lot of people do actually pay more frequently, but the obligation is to pay 28 days after the end of the quarter in which those entitlements are accrued. Clearly, this is going to mean changes in law. We're going to need changes in payroll systems and other systems and so forth. And we also want to give businesses the opportunity to manage and adjust their cash flow to comply with these new obligations. And hence, that is why we have this delayed start date to the 1st of July. Why are we doing this? Well, it is supposed to increase visibility for employees to see when their superannuation is actually paid. It will give the ATO better scope to recover unpaid amounts and, of course, support better retirement outcomes when we've got more money going into super in a more timely manner. Interestingly, the ATO estimates that some $3.4 billion in unpaid entitlements existed in the 2019-20 years. So clearly this will be a great measure to see implemented. I'll be keen to see whether or not the visibility aspect for employees actually comes to fruition in a meaningful way. So clearly we can see whether we receive our salary and wages by checking our bank accounts. Not always easy to check whether or not your superannuation fund has actually received your contributions. So hoping to see some more specific measures to ensure actual visibility for employees around payment of super guarantee obligations. Just a quick reminder also on this one is that the SG rate is going up to 11% from the 1st of July 2023, then another 0.5% the year after, and then full implementation to 12% from the following year. So just keep an eye on that one as well. The third measure that we saw come through last year, it may have been overlooked by some people, interestingly, as having little impact, but this one is very significant for the superannuation industry and, importantly, retirement savings for everybody. So under current law, when there are non-arm's length expenses in the super fund, it can result in the non-arm's length income provisions being imposed. And what this means is that where an expense is incurred at less than what would be paid if the fund had actually been dealing on an arm's length basis, or indeed an expense was not incurred, it can result in the income of the fund being taxed at the highest marginal tax rate of 45%. So basically what we're sort of seeing is a minor infraction or minor reduction of fee that would be paid can have quite catastrophic impact on the funds, which under current legislation could have impacted large super funds as well. So all super funds and hence everyone's retirement savings could have been impacted on these measures. The problem actually arose is because when we impose non-arm's length income provisions, we generally look to a nexus between the expenses and the relevant income. So that would be evident in property management fees, would be applicable to income, say rental income. The problem was that the ATO had a view that when general expenses, so that's your accounting fees, administration fees, bookkeeping fees and the like, when they were not paid on an arm's length basis, they actually had sufficient nexus to all income of the fund. So again, a minor infraction would have resulted in all income of the fund, including capital gains, being taxed at the highest marginal tax rate. We saw a consultation paper come through in January 23 on how to address these particular issues. There was a lot of industry feedback on it. And as part of last night's budget, the government announced some changes to their approach on how they were going to deal with this particular measure. So a big win for the APRA-regulated sector in that large APRA funds will be exempt from these provisions for both general and specific expenses. So, yeah, as I said, a big win for them. Unfortunately, self-managed super funds and small APRA funds will still be included. So if you happen to have one of those 600,000 self-managed super funds, keep an eye on these measures because you will be impacted, and it is important to make sure that expenses are paid on an arm's length basis. The big change that did come through from this one is the consultation paper had originally suggested that the income that could be taxed in relation to a non-arm's length expense would be limited to 5 times that general expense, and last night they announced that it would only be 2 times. So twice the general expense would be what was coming through in taxable income. So a much better outcome. Don't believe we're quite there yet on this one, but nevertheless a move in the right direction. So David, back over to you.
Very good, and thanks so much. Last topic, very briefly, indirect taxes. I've alluded to this at the start of the session. The ATO will receive some additional $580 million to expand a GST compliance program. As I say, the forecast revenue over the forward estimates is $7.6 billion, significant additional revenue relative to the additional funding to the ATO of some $600 million. Interestingly, whilst this is a GST compliance program, the limited information that we've got so far from Budget Paper 2 says that the $7.6 billion of estimated revenue will be split essentially in 2 halves. Half of that is expected to be additional GST revenue, and half of that is described as being other tax receipts. Now, it's not clear exactly what that is, but it may be that an expected consequential impact of this GST compliance program is that various activities and businesses that are operating outside of the mainstream tax system in the shadow economy will be brought within the mainstream tax system, resulting not only in GST income collections, but also income tax collections. The GST tax gap is currently one of the largest gaps, both in percentage terms and dollar terms, and clearly the strategy that we've seen from the ATO over recent years is to focus on those tax gaps. Where are the largest tax gaps? What is the compliance response that needs to be put in place to respond to that tax gap? What is the funding that is needed to deliver those programs with a view to, over time, reducing those tax gaps? We've seen that in the large market segment. We've seen that approach starting to affect other segments, and it's now that same strategy being applied to reduce the GST gap and also raise additional related revenues. So that really brings us to the end of this session. Just a couple of concluding comments. I started at the top of the session saying this was not a big, busy tax budget, true enough, but I think for most taxpayers, there will be something of relevance that's on the table at the moment. It may be some or all of those multinational exposure drafts that are sitting out there relating to interest deductions, relating to intangibles, relating to public country CBC. Each of those are significant measures in their own right. Each of those due to commence on or around 1 July of this year. Separate to that, we now know with certainty that Pillar 2 is coming down the line in short order. Significant work for taxpayers to do, affected taxpayers to do, to be prepared for Pillar 2. In addition to that, as Enzo's run through, there's a number of sector-specific measures relevant to particular types of taxpayers and particular size of taxpayers. So not lots of tax measures announced last night, but lots of open issues on the table as we run into 30 June and then run into 1 January 2024. If you have any questions in relation to any of those matters as they affect you, please feel free to contact your regular Deloitte contact. Alternatively, more than welcome to contact me, David Watkins, in the first instance. But as we wrap up now, hopefully that was a helpful overview of the key tax measures announced last night. With that, let me thank you again for your attendance, thank my fellow presenters, and say farewell. Thank you very much.